We want to ask you some hedge fund stuff because you are one of the people that we know who are among the most knowledgeable. Given your experience as a GP, what are all the new LPs in wealth management missing as they allocate to alts and private equity and hedge fund-like strategies and things that they just haven't in the past? You've sat on the other side, famously at Bridgewater during a massive run-up for macro hedge fund investing. What do you think people are missing now who are coming from where Michael and I are in the wealth management space?
Yeah.
Because they seem to be voraciously allocating. So talk a little bit about what you're seeing and what you think might be being missed.
Yeah, well, I think one of the big things is everyone's into these illiquid products.
Yeah, they love it.
And not recognizing that you're not getting your money. So I don't know if you pull up chart 19, like one of the biggest things that you see is
what is this?
What this shows is the quarterly distribution rate of, private equity, venture capital, et cetera. And it is
yikes.
It is
you
terrible.
Can't distribute because there's no exits.
That's right.
Okay.
That's right. So when you talk to somebody about investing in venture capital, it used to be, you'd allocate, you get capital calls over the first 2.5 years,
5 years, 6 years, you get your money
and then
out.
5-6 years, you get your money back. The way it works now is all your capital gets called and you never see your money.
Yeah. Until companies can go public or get acquired.
Right. Which, and now we're seeing venture capital distribution rates at 5%. Essentially you're just never seeing the capital.
Yeah.
And that has all sorts of consequences around liquidity of portfolios because people aren't, particularly when we talk to like big institutional investors, they are stuck in a pickle, which is they expect the money to be coming in the door and the money's not coming.
They have nobody to sell assets to.
Right.
Like they can't they can't turn these companies fast enough to return capital.
And in particular, when you think about part of the whole story is very strong IRRs in these.
Yeah.
And when you had venture capital, you allocate in 2.5 years, 3 years, and then you get exit starting in year 5, et cetera. That's where you get very, very strong IRRs. Well, if it takes 10 years or 15 years to get your money, then it totally blows out the IRRs. Why would you ever invest in venture capital, pay all those fees, take that illiquidity when the cash flows are so extended?
I see. The interval is becoming so long that it's limiting how much you can make per year.
Exactly. And so basically in this sort of circumstance, it makes no sense to invest in these sorts of investments relative to investing in the public markets. Right? You're having a negative penalty. Is
that one of the big drivers for why the private equity and alts people are coming so hard at wealth management?
Yes.
Yeah.
Because they need liquidity. They need another pool of capital to come in,
in particular,
while they're waiting for institutional capital to get back out.
In particular, I mean, the way it used to work is you'd invest in a fund vintage, you get your money paid out,
and then you go back into the next one.
Go back into the next vintage,
but you can't re-up if you don't get your money out.
Exactly. And so what do these companies have to grow their assets? So the only way to grow them is to go talk to people like yourselves to try and get, smaller scale investors to come back in.
I shudder to think who they go to after us. When they're done with wealth management, where do they go to FanDuel?